Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoy today's podcast. Hi and welcome to the latest in our New Zealand property podcast series. Now this one today was actually recorded some time ago with Hadar Orkibi, and we talk about something that a lot of investors want to know about, which is the property cycle. So we'll start off by welcoming Hadar along and telling us about the cycle.
No worries, pleasure. Well, from a trader and also from long-term investors, both type of real estate professionals, whether you wear two hats or one hat, you should familiarize themselves with the property cycle. It's a key fundamental property-related economic cycle, which if you don't know it, you miss out, and you might make mistakes which could cost you dearly, or you can take advantage of them. And by timing your actions right, you can actually gain massive gains out of it. So let's go back to the property cycle in terms of just general description of it. Imagine yourself a round clock, the one you have on the wall in your kitchen or your living room. Imagine that between around 10:30 to 1 o'clock, it's the boom time. And between 2 o'clock to 6 o'clock, it's the slump, meaning property prices are on the trend down. And between 6 o'clock, around 6 o'clock, exactly 6 o'clock, when it's right down, it's the recession and the bust. It's the bottom of the cycle, the lowest point of price drop, and they dropped the lowest they will go, and the economy is basically the lowest it will be. Then from 7 o'clock again up to 10:30, it's the recovery phase and the upturn phase, just before the early beginning of the boom again. So it goes around in circles from 12 to 12, and every section we just described, which is the main section, the boom, the slump, the recession, and the upturn recovery, are the sections which you apply different strategies within those sections.
Before we go into different strategies during the cycle, in your opinion, what drives the cycle, and what are some of the indicators?
Sure. Property cycles are happening every few years. Some property cycles happening every 7 to 10 years. The patterns are not the same every cycle. Some cycles, the boom can be shorter or longer. The slump can be shorter or longer, and they're not the same. All cycles are not the same. The cycles in the 30s are not the same cycles that we have today, or cycles in the 50s are not the same cycle we have today. But one thing is for sure, the economic cycle and the property cycle are reoccurring every few years. And some reasons or the key drivers of the cycles could change as well within each cycle. So I'm not an expert of property cycle. I haven't been researching it for years and years like some other people did, but I made sure I read enough books about it. For example, Kieran Terrace has a great book about it, and I read it a few years ago, a little bit too late for me, I would know how to use the cycle to be able to be investing counter cycle. So there's a few other books which cover it, but Kieran's book is dedicated for that particular, and I'm sure you can possibly find it on Amazon as well. I think it's called Grow Rich with the Property Cycle by Kieran Terrace. I can speak about the last cycle we had, the cycle which ended up with boom, but then big bust of the GFC, the great financial crisis we had. One of the key drivers for that boom, for that upturn, and the way the market's gone mental and gone beyond every level which we've seen, even in capital growth in this cycle, in the current cycle, which we are now in the high turn and the boom section, it's the free credit that we had. The global economy in the States, in New Zealand, in Australia, everybody could have gone in and apply for loans without verifying income. We had low docs and no docs over there. Which I just started investing in 2006, 2007, and luckily I managed to get some line of credits lined up at the time when the credit was available, and then the market just tanked up. So we had credit for all, free credit. Money is everywhere. It's easy to get a loan. Everybody can go and buy and pay higher prices for properties. That's one of the drivers. One key driver is immigration. We had very strong net migration in the last cycle, and now we're having a strong migration as well. That's why we are in the property boom. It's one of the key driver of a property upturn and a property when the property prices are peaking. Construction activities, when the construction activities are picking up or in full swing, that's also one of the indication that we are entering a boom period. Saying that, the way to monitor it is to keep an eye on building consent, on consent numbers. When consent numbers are increasing, usually within the recovery phase, you know that we are heading towards a property boom. Not necessarily a bubble. We're not talking about bubbles here. We're talking about a strong property market, which it's a seller's market. Supply and demand is also very strong in the boom. And that pushes, again, if there is a free credit or property is a flavor of the month, then you have more buyers in the market, which push prices up. And not as a rule, and I know that in the 80s, interest rates were very high globally, and prices still kept going up, and they had a bubble. I wasn't investing those days, but I'm aware of that. Low interest rate can trigger strong activities in the property cycle. When the interest rates are historically low, there is more. Obviously, property investors and home buyers have the opportunity to get into the market. And if you invest a property, your costs are lower because your mortgage payments are going to be lower. And if you're a home buyer, houses are more affordable, which stimulates the economy and people wanting to get in.
So you're saying the peak or strong time, hence a sort of strong construction, migration, relatively free credit, and we saw that last time certainly, low interest and lots of consents. The harder one people find is, or investors find, when should you buy? So, in your opinion, when can you tell the time is right to buy the property?
Okay, sure. The optimum time to buy, in my views, and I actually wrote an article about it on propertygenie.co.nz, and it would be great if you can actually put a link to that article on your show notes. In my view, the optimum time to buy property is just in the very, very, very early recovery stages, when the property slumped and the recession is full on. But when you start seeing the little growth of green shoots coming from the economy and the property cycle, this is the optimum time to be buying investment property, whether you are buying hold or whether you are buying to develop and trade. If you get it right, which is pretty hard, but if you are in the market on a regular basis, there are signs which you could pick up, and that could be only a clue for what is ahead. And this time is a good time to buy and hold, because the sellers and the market and the sentiment is not there yet to actually push prices up, and the market is still subdued, and properties are taking longer to sell. And it's also a good time to buy potential flips or properties you're going to trade, whether you rehab them and sell them, or whether you will be putting them back on the market when in a couple of years when the market is better. Every phase of the cycle takes a few years. It doesn't happen overnight, jumping from the boom to the bust. That could be a process of maybe 3 years. So the optimum time to buy is in the very early stage of recovery, which is just when the property market is just nudging the seconds long arm of the clock is just starting to pass the 6 o'clock.
Okay, Hadar. So you say nudging 6 o'clock. So what specifically would you buy, starting maybe from we'll start from the boom period?
Yes, there are main. There's a lot of key driver and indication which one could follow. There are a few favorites of mine which helps me to monitor it, and I'll share it with you guys. But let's start first. When a property cycle is in a boom, again, you can see that property values are rising by around 10% per annum or per month. And value are going up, and finance is usually a bit easier to obtain. The share market is picking up, and there is a lot of demand from homeowners and investors. And over the boom period, you will see that houses are less affordable. They're becoming less affordable. The media is talking about affordability and how the housing market is becoming less affordable or less affordable. The economy is usually strong. The unemployment rate is lower, so there is more people employed. And the real estate is the flavor of the month. Everybody is talking about it. Any person who is in your dinner table will be trying to do something in real estate or talk about real estate. And the mom and dad investors are getting in and buying another rental property or trying to get into the rental market. New investors are coming to the market keen as to be financial free and going into property seminars, and suddenly there are more hype about property seminars and stuff like that. And the key driver, which is a key indication, I would actually say, I won't say it's a key driver, is the time that it takes the property to how long properties are sitting on the market and how long do they take to sell. In a boom time, properties will be selling for under 30 days. They'll be selling at under the hammer at auction for high bids, and they'll be taking to sell within 2 weeks and stuff like that if they're listed with a price. So any when the market properties are selling for under 30 days, it's a strong market. The yields are dropping, so the returns on investment are dropping because value have risen, and it's getting harder to find deals. And construction is booming, and you see that many listings are selling very, very fast. They don't last long on the market. That's where the boom. That's the signs you can see, and if you identify all of those, you'll know that we are in a property boom.
So then, as an investor, what should you be doing in the middle of a property boom?
One thing you shouldn't do is be in a hurry to jump on deals if you think they're great, because after the boom comes the bust and comes the slump. And like I mentioned in previous podcast, I bought a property for a certain price, and it was a great deal at the time in the boom. But 12 months later, when the global financial crisis struck and the market tanked and finance wasn't available, the property, I couldn't get what I paid for it, and or I could have got what I paid for it, but all the equity I thought I made, which was a great deal at the time, wasn't there. So don't be in a rush. And in the boom time, I generally prefer to be in the early stages trading, So a lot of hype, a lot of people actually. So it's good to have stock to actually sell because you can get good prices for them. And it's also a good time to be adding value for your own portfolio and your properties. So if you add value, you will be basically enjoying the capital gain of the added value. I'll give you a quick example. I have a block of flats with, again, multi-family home. It's a block of 4 two-bedroom flats, brick and tile, permanent material, which purchased for 870,000 in Auckland, in Mount Wellington. Spent 120,000 unit titling the block of flats. Let's say 130, just round her up. So let's say it owes us $1 million. We were expecting the property on separate title. Obviously, I always buy properties with the opportunity to add value, so I knew there is the opportunity there, but we were expecting it to be valued around the 1.3 level. And while the market, we did it just in the early stages of the boom, and I got it valued just a couple of months ago, and it's valued at 1.455. So that's 455,000 of equity. So we gain another 150 just within, 8 months when the recovery, for example, took to pick up speed and when it's kicked in to be actually a boom center of the boom stage.
Yeah, that's a great result, Hadar.
It is, and that's how you can, if you get the timing right, you can improve your own properties and increase your equity position, and that was quite handy, especially with the loan to value restriction that the New Zealand government or the Reserve Bank have been implemented here in New Zealand. Which is restricted the borrowing up to 80%. So the LVR is gone down quite significantly by this added value, which put me in a better position to keep investing and trading. So that's what I'll do in the boom. In the boom, you basically add value to your own property, very, very carefully purchase trades if you can do flips and stuff, which will be a short-term transaction. You just don't want to make sure you're not trying to make sure you're not going to get caught up in the end of the tail of the boom. If there is any global crisis or something, then obviously things can change quite rapidly. So that's what I think it's the best to do in the boom. So when we're reaching towards the end of the boom, sort of beginning of the slump, I will expect to see the credit is tightening up. There could be some market influences like government regulation, like different taxes that came towards the end of the boom, which the government trying to cool up the housing market, different taxes or the loan-to-value restriction we have seen that the government or the Reserve Bank introduced to cool up the market. Interest rates usually are picking up towards the end of the boom. Again, this is a driver or a thing which is not exactly the same in every cycle, but we've seen it already in two cycles, previous cycle and the current cycle. Prices are starting to drop, is back, or even getting a bit more stale. Properties are clearing rates in auctions are slowing down. Less properties are selling under the hammers. Unemployment rate starting to rise. Lower migrations, and the contractors' activities is lowering down as well. Construction is slowing down, less building consents issued. And very important thing, again, to monitor, we're going back to the number of days it takes to sell to property. So the days the property takes to be sold or sitting on the market is rising. More properties, listings, more inventories, properties becomes a little bit more affordable. Later on, when the slump starting to kick in, affordability level goes when prices start dropping. So the key element to keep an eye for, again, there is the days it takes to sell. When the property is sitting on the market for longer, It could be that the market is just turning to be a buyer's agent from a seller's agent. A seller market, sorry, a buyer's market from a seller's market.
So then, you're still not looking at buying heavily at this time even?
Look, I'm a believer of the there's always a good deal to be held, no matter what part of the cycle you are at, provided you buy well and provided we stick to the principle of you make your money when you buy. But going back to my Christchurch example, my 2007 example, is I was buying well. I was buying at a discount at the time, but because the market corrected, this equity was gone. So preferably, it's not a good time to buy when the market is peaking. It's like the saying go, be greedy when others are fearful, be fearful when others are greedy. So in the boom, you need to be fearful. You need to be cautious. And that's what Warren Buffett's words.
So then, we're now getting in the area where property sales are taking longer. Maybe property isn't the dinner time conversation anymore. And you're almost thinking, when the butcher tells you it's time to buy, the clock must be ticking and we're heading into the serious bad news area of the cycle.
Yes. I just want to give a good thumbs up for some butchers and taxi drivers. I wouldn't, with property investors, you never know who owns what. So I know of a butcher who owns 4 commercial properties and taxi driver who's got a portfolio of 10 properties and stuff like that. So thumbs up. Okay, so the middle of the slump, I would say towards the late parts of the slump, around let's say 3 to 4 o'clock on the property clock, you will see low sale volumes, more supply than demand, and a lot of the things which we mentioned in the boom, like the things like days on the market peaking. So properties are taking very longer to sell. Peaking mortgagee sales. You see much more mortgagee sales and forced sales. There's foreclosures. Days to sales again is peaking. A lot of stay listing, a lot of properties who didn't sell at auction and sitting on the market for ages, and for various regions they're less attractive. There is more motivated vendors, more people trying to sell privately, and suddenly affordability is better. And the media is just doom and gloom. Everything is doom and gloom about property. That's a great sign. I love to hear that. As far as I'm concerned, the better. As far as the media is going to brainwash all the sellers that the market is going to collapse and property is not the flavor of the month, I'm very happy with those news, because it gives us more opportunities to work with vendors who are more motivated. Another point that we see, and we saw it in the last slump, which we just passed through, 2007 to 2011, we see more number of people per household. So a lot of people, because the economy is not great, and because unemployment is increasing, a lot of people are moving to live back with their parents, or people teaming up to live together so they can share the cost of the rent, and that's another sign. More increasing number of people per household. Yes, and another thing I noticed as well in the previous slump, which is it's quite a good sign, is many real estate agents actually leave the industry. They just can't make it. There's not enough sales. There's not enough turnover. There's not enough listing from there to stay in the industry, and that's also a very good sign.
Well, this has gone a wee bit longer than I thought it might. We've really dived into the property cycle and the clock, halfway through the clock, as Hadar talks about. So we'll stop it there for this week, and you tune in next week and you can catch the remainder of the property cycle by Hadar.